Hello everyone. Welcome to the module number 4, Introduction to Finance, Sources of Finance Part 2. So I'm your Professor Harsirat Kaur. So today we will talk about what are the sources of finance other than the securities that we have talked about in the last session. In today's session, we will talk about the sources of finance through creditorship securities. In the last session, we talked about the equity shares, the preference shares, which is the ownership security, in which we can raise the sources of finance from ownership by equity shares or by preference share, by having stocks or shares in particular industry. But in today's session we will talk about how creditorship, how debt, by giving debt, how a company can raise, or how can a company can raise sources in the company, in an organization, by giving debt to the people, by giving them the privilege to them in order to invest in the company, and by giving them consecutive payments, returns on their investment in the form of coupons. And that all we are going to study today, that how different kind of institutions as well, commercial banks, development banks, these are the financial institutions which help the companies, which help the people, for small businesses, middle-sized businesses, and large organizations. So different financial institutions help different kind of companies in order to grow. And yes, so all these kind of stuff we are going to learn today, so which is exciting. So let's go. Okay, sources of finance, part 2. First of all, is what is a creditorship security? Creditorship security is a financial instrument, is a financial legal method in which we mobilize the finance in a company from the creditors. Okay, so this is also called debt finance. So when a source of finance, when the finance is sourced in the term of giving debt or taking debt, is called creditorship securities. So there are two types of creditorship securities that we are going to study today. Number one is debenture, number two is bonds. So debenture is also one kind of bond, but in bonds there is a security, but debentures are unsecured securities. So that we are going to talk about everything today. So debenture. So first of all, what is a debenture? Debenture is a document issued by a company. It is a certificate, legal certificate, which is issued by a company to the person who, to the person acknowledging its seal, like the company who is offering debt to the bond holder under its seal. So they have for example, sorry, they have a seal of the company over that legal document, showing that the company, the person who have taken the paper. For example, if I am the issuer and the other person is the holder of that legal document, then that person is investing certain amount of money in the company. So the company who is issuing the debenture have a legal seal over their company seal, that the person, the holder, have invested that amount of money in the company, and the issuer will pay the holder that some amount of return in the form of income, in the form of interest, simultaneously, maybe monthly, maybe quarterly, maybe yearly. So this is all what we call debenture. And debentures are legal, not legal document, actually unsecured bond. Why? Because when we talk about bonds are secured, because bonds are secured by backing up with some fixed assets. Okay, so let's say if one company is fails to comply with the holder's conditions, then the holder has a right to claim their concept over the assets or over the backing assets of the company. However, in debentures, it's not the case. They have nothing for the security. It's only the credit worthiness of the issuer, credit worthiness of the company. So in case of any worst cases, the issuer cannot claim over it. So this is all about debentures. So here you can see that debentures can be issued on the basis of convertibility. So they are redeemable and irredeemable debentures, fully and partially convertible debentures. So there are two types on the basis of convertibility. So on the basis of convertibility means that you can redeem after a certain period of time your initial investment with the interest that have been written in the contract, and irredeemable means you cannot redeem it after a certain period of time. However, there is a privilege that you can convert your debenture into equity shares, that you have this privilege. So this is one of the case which is advantages of a debenture. Another thing is security. On the basis of security, they are secured and unsecured debentures. So secured debenture is called a bond. First mortgage and second mortgage debentures. On the basis of transferability, registered and unregistered. On the basis of interest rate, fixed and floating rate. So fixed rates are the ones which are fixed for the entire period of time that they have been. No macroeconomic factor, for example, inflation, uh, currency rise in the currency rate, that won't affect the rate of interest that is being issued. However, floating rate would depend upon the macroeconomic factors of the economy. However, on the basis of coupon rate, so that we are going to study today. Okay, there are different types of debentures that we are going to talk about today. Unsecured debentures. Unsecured debentures are the debentures which are not given any security on the assets of the company. So it is also called naked or simple debentures. So these debentures are traded as unsecured creditors at the time of winding up of the company. So for example, I invested some money in the company, and the company in the debentures of some company, but I don't have any claim over the assets in case of emergency, in case of winding up of the company. I don't have any right over the assets of the company. However, the rate of interest is high. On the other side, the risk factor is high as well. This kind of company would issue high rate of interest, but there is risk also associated with it. However, secured debentures are the debentures which are traded as a given security on the assets of the company. So in secured debentures, the company who is the issuer will give you the debenture, will give you the legal document on the assets of the company. It's a mortgage over the assets of the company. Okay, so the holder have the right to claim about over the assets of the company in any case of emergency. So it's a security that have been given on the assets of the company. Another one is redeemable debenture. So redeemable debentures are the debentures which can be redeemed after expiry of the certain period. So interest is paid periodically by the company, and the initial investment is also returned after the maturity period. Okay. Next one is irredeemable debenture. These kind of debentures cannot be redeemed after the period of time that have been written in the legal document, and the debenture is written in a legal document which is called indenture. So indenture is a contract which is being made between the bondholder and the bond issuer. So this is called indenture. This is a legal document. Moving further, there are convertible debentures. So convertible debentures are those debentures where the holders have the option that they can convert the debenture into equity shares, maybe partially or maybe wholly. So it's like the issuer have the right to have share in the company, not only for a not only on a creditorship security that they are having the interest, also they can have the ownership in the company, so they have the privilege to do it. So the ones who own the debenture have the right to do it. So non-convertible, fully convertible, or partially convertible, there are three types of debentures which falls under this category. Another types, there are another kind of debentures as well. So collateral, guaranteed, first debenture, zero coupon bond, zero interest bond. Okay. Here is one example that is of debenture that you can see here, that how the US Treasury bonds are is an example of a debenture. So, however, T bonds, these are called T bonds, Treasury bonds, are nearly risk-free since they are backed up by full faith and credit of US government. So they are the government bonds. Okay, so government bond have the credit worthiness and the reputation and have a trade confidence over them because it is a legal identity, legal institution. However, it is not the case, not the same case when it is considered to be a corporation or other private company. However, they are also face the risk of macroeconomic factors like GDP, interest rates increase, inflation. So these factors affect them. Here you can see, okay, what is a debenture? So characteristics of a debenture. Debenture is a certificate that the company issues under its seals called debenture deed. It shows the amount and the date of repayment plus interest. Okay. Another, these are the borrowed funds. So debentures are a part of borrowed fund capital. The holder of debentures are the creditors of the company. Okay, so the ones who hold the bond of debenture are the creditors of the company. They are crediting the company, and the company is paying them the debt in the form of rate of interest. So that rate of interest that is being offered to the issuer in periodically, and if it is a redeemable debenture, the holder will receive back the amount of money that they have invested. It is a written promise, it's a legal document which is written, which acknowledges a loan or a debt, and it has a maturity period for 10 or 20 years generally, which if it is a long-term source of finance. Okay, claim in assets. So debenture holders are eligible to get a fixed rate of interest. They have a priority over shareholders when it comes to the claim over the assets. Okay, other characteristics: power control, fixed rate of interest. So these all are the features of a debenture. Now what are the advantages of a debenture? For example, debenture is a long-term source, so normal maturity period is longer. That's why you can receive the rate of interest for a long period of time. You have a fixed rate of interest, okay, that is being offered by the companies. If so trade on equity, so company can trade on equity by mixing debentures in its capital structure. So the company, so for example, if the company have money in the company, then they trade on equity. Okay, equity concept. So which increase, so when the company has equity, their retained earnings would be high, and this will increase the value of the company as well. Another part is income tax reduction. So interest that is payable to debentures can be deducted from the total profit of the company. So when the company pays interest to the issuer, to the bond holder, then they can subtract it from their income tax, that they get rebate over that. So protection is also there. Okay, so here I would like to explain you about the internal finance of the company. So these are the things that we were discussing about equity sources of finance and creditorship securities of the finance. These are the two different departments. Now we will see that how we can increase the funds we can generate the sources of finances internally in the company. There are two sides, right? External and internal. So the new company may not raise internal sources of finance, but they can do it from external sources like debentures, shares, loans. But the company which is existing for a long period of time can raise both internal and external sources of finance. Okay, so internal sources of finance are depreciation funds and retained earnings. So now we will talk about internal finance of the company. So how the existing companies can raise funds from internal of the company. So what is working capital? Working capital is the measure of financial health of a company, whether the company have the capability to fulfill their short-term obligations. So whether do they have the current assets. Current assets are the ones, as I was already explaining to you in the first module, that current assets are the one which can be converted into cash very soon. So who have short period of time. So these are the current assets. So whether the company have current assets that they can pay their short-term debts, short-term liabilities or not. So that is called a working capital, which tells about the capability of the company. It defines their operational efficiency and short-term financial health. So for example, hair salon with the assets of $160,000 and the liabilities of $65,000. So what is their working capital? So their working capital is $95,000, which is their cash, which is their short-term debt, which is their inventory and operational finances, expenses. Okay, so this is the definition of working capital. So here we would see what is a depreciation fund. So depreciation means that the decrease in the value of an asset due to the period of time, due to maybe accident, due to its expiry date, due to the wear and tear of the machinery. For example, you are a company who have bought a machinery and whose worth is $500,000. So in 5 years, if the machine every year, for example, so you have a time period of 5 years and you have to make profit out of that machine in 5 years, the cost of the machine, which is $500,000. So every year you should earn $100,000. So in 5 years the value of the asset would be depreciated. Maybe in 5 years, when you recover the cost of the asset completely, and after 5 years or after certain period of time, when the every year the device get depreciated. Okay, so every year the value of the device get decreased. Okay, maybe because of wear and tear, because it is being used, maybe some accident may happen, so that is called depreciation. So we always subtract it. If we have some fixed assets, so we always subtract it from our income statement. So this could help us in order to have reduce the tax burden as well. So the amount that we depreciate, we get tax rebate over that, so it benefits the profitability of the company and it's good. That is called depreciation fund. So depreciation fund represents the assets value that have been used. Okay, so companies depreciating assets help the companies to earn revenue, helps to reduce the tax every year. Okay, so here you can see that where we mention the depreciation and expenses, so we minus it, we subtract it from our revenue. So these are the depreciation expense that we do, and it helps us in terms of tax reducing. Moving further, if we talk about retained earnings. Now, what are retained earnings? Retained earnings are the earnings that left after paying all the liabilities in the company. So whatever amount is left is called retained earnings. So for example, retained earnings are the earnings which belongs to the company. So these amount of money you can invest for further investments in order to increase or in order to develop your company. So these are the reserves that you have in the company. So it has less cost of capital, more it helps to make the company more attractive as well. So this is also called accumulation of profits by the company. Okay. So moving further, what are the advantages? It makes the company more attractive. When the company have money, the more and more investors can invest into it. More financial efficiency. You can see economical sources of finance, less cost of capital, no obligation. You don't have to pay dividend. You don't have to finance company by paying to others. You already have you don't have to pay interest, so you already have your retained earnings, so no fixed obligation. Okay. Economical sources of finance. So retained earnings are one of the least costly sources of finance, because it does not involve any cost of floating cost. For example, it doesn't have any cost that you have to pay back to the holders, like in debentures, right? Useful for expansion and diversification. So if you have money in the company, you can use it for further diversification of your business activities, maybe expansion, maybe enhancements, maybe product purchasings, everything. Flexible sources. So retained earnings are the financial instrument which have flexible source. So company need not to raise any kind of loan and any other method. So if they have retained earnings, it increase the share value as well. So if the company have money in house, then the cost of capital is cheap. It makes the company more attractive, and the value of the share in the market also increase. Avoid excessive tax. So of course it provides opportunities to reduce the excessive tax in a company, because you have your own money in the company, so you don't need more investors. That's why you don't have to pay more tax. Increase in earning capacity. Of course, it's the money. If you have money, then it increase your capability as a company. Moving further, loan financing. Loan financing is another method by which by which a person can have loan from commercial banks, from development banks, or special institutions which offer financial support to small, middle, and big corporations. So that could be long-term loans or short-term loans. Long-term loans are often more than 10 years. They have payback period of more than 10 years. However, short-term loans are kind of short-term advances that are being given to the people on security of an asset or something which is very uh, you know on the basis of some security normally. Okay. So there are commercial banks which are financial institutions which offer short-term loans to the people. For example, they give houses on mortgages, car loans, business loans, study loans. These are the kind of financial institutions which offer financial support in order to do short-term financial activities. Okay. So for example, short-term advance provide advance to their customers with or without securities. Even if the customer do not lend anything as a security to the bank, but they already offer them in order to meet their working capital requirement, in order to help them to meet their short-term obligations. Okay, for example, mortgages and short-term loans. Short-term loans can be given on the basis of cash credit or overdraft. So what is a cash credit? Cash credit is when a bank allows its customers to borrow money over a certain limit against a security of something, a fixed asset, maybe a house, maybe some for gold, okay, some fixed thing. So they offered them some kind of credit against some security, and there is always certain limit that you have this much limit, and the for example your credit cards have certain limit, right? Another one is overdraft. Overdraft is a kind of arrangement which is being offered to a current account holder and withdraw, and the holder could withdraw more than the balance to his credit limit without any security. So you can increase. Okay, moving further, development banks. Development banks are the banks which help the industrial sector to grow. So they have, for example, they help multinational companies, multinational brands to and organization to help them in development, or sometimes they offer help to financial help to the industrial sectors in order to sorry in order to do financial developments, in order to do urban developments, development of some area. So these are the development banks. So here you can see what is the role of development banks: providing funds, infrastructure facilities, promotional activities, developments, development of backward areas, industrialization, employment generation. So what is indirect finance and what is a direct finance? When there is a relationship between the lender and the borrower, direct, so that is called direct finance. But when there is a intermediary in between, brokers, and then the finance happens between two persons and there is a middleman in between. So when this happens, this is called indirect finance. So thank you so much for your attention, and if you have any question, you can always write to me. See you in the next class. Bye.